What is up, guys? Welcome back to another video. And today it is the end of November and I want to go over some companies that I think are looking very attractive for buys for the month of December. Or just right now if you want to buy in the end of November, that's also fine. And quick disclaimer, I already own the first three companies that I'm going to present and I consider buying the fourth as well. So take all of my information here with a grain of salt. I might be biased. And of course, this is not financial advice or anything. If you want to invest on the stock market, then please do more work than just listen to me. That's not sufficient. In any case, I have structured it this way that the first two companies are more growth oriented and they are also part of my growth portfolio. In case you don't know, I have a growth portfolio where I focus on very fast growing companies. Who could have guessed? And in my second portfolio, I focus more so on dividend paying stocks. That doesn't mean that in the growth portfolio there are no dividend payers, but it's not a priority and it's not a necessity to be included in the portfolio. So the first company on my list is going to be Mercado Libre. And this is for a very simple reason, because we just recently had a little dip down from the 52 weeks high. If we look at the drawdown, we are now in a 23% drawdown. A couple of days ago, we were at almost a 30% drawdown from recent highs. And this is just a very high quality company. And to prove that, Mercado Libre is cited as the only company to have achieved 27 consecutive quarters of 30+% revenue growth. The only company to ever exist, at least on the public market, because if it's a private company, we don't really know what they're doing. But this is absolutely incredible. No other company has ever managed to grow for as long, as strongly, as consistently as Mercado Libre, at least on a top line. So that's got to be worth something. And if we look at predictions here, revenue is estimated to stay at around 30%, slightly above that for the coming 2 years. So they are probably going to be able to squeeze a few more quarters of 30+% revenue growth out of the business, which is absolutely incredible. We can also see this by looking at this chart. This is a beauty to behold over the last, 9 years or so. The revenue growth compounded, it has grown at 46% per year. Show me any business that has managed to do this consistently each quarter after quarter. This is a yearly view because I have the free version of fiscal.ia. Now you might say, oh, okay, it's revenue, that's great and all, but at the end of the day, it's profits that determine whether a stock is more or less valuable than it was before, and you're absolutely right about that. But it's important to keep in mind that revenue is the thing that enables profits to grow, right? If revenue doesn't grow, profits can grow by margin expansion, but only so much. Like you can't get past a certain margin level. And if we look at earnings per share, it is always important to keep in mind that the company isn't optimized for profitability. It's similar to Amazon in that regard, that they constantly reinvest into the business and thus their profits look a lot worse than they could be if they were really focused on delivering maximum profits. So this is important to keep in mind. Nevertheless, we saw that, well, starting from the COVID area, we have really expanded our earnings per share. Now $41, you might think, wow, that's quite a lot of earnings per share, but keep in mind that one share is worth $2,000 right now. So that puts it into perspective a little bit. Now, in terms of what the company actually does, you probably have heard of it as the Amazon of Latin America. And that's not exactly wrong, but it's also not very precise definition. So the most important part here is also the e-commerce part of the business. We see a gross merchandise volume, 28% year-over-year growth. On an FX neutral basis, even 35%. Items sold up almost 40%. Total payment volume, that's the next part. We also have a fintech side of the business with a payment solution and also a loan solution. So we see here a total payment volume is up also very significant amounts. The credit portfolio almost doubled year over year, which is absolutely insane. And really those are the two main parts of the business, e-commerce and financials. and there's also some advertisement and some entertainment, but those are really secondary and don't move the business in either way. And we can see that pretty much all metrics are growing and looking healthy. Again, the operating margin and net income margin are naturally suppressed because, well, e-commerce is very capital intensive, and also in the last quarter they reduced the total payment amount that you have to have for one order in order to get free shipping. And this, of course, also depresses margins a little bit, but makes them much more competitive and makes it harder for competitors like Amazon and Shopee from C Limited to compete with them. And so after looking at all of that, let's come to valuation. And we can see that, well, it's pretty much trading all the way at its lows. Yeah, we can see the minimum was around 34 forward PE. Now we're sitting at 39. But if you look at the whole range, well, I can talk about the median line. The median sits at 51 forward PE. So we are a lot closer to the minimum than we are to the median, let alone the maximum. For a company that is expected to grow 30% plus and has a very good track record of actually doing so, I think that a 39 forward PE, also keeping in mind that it's not optimized for profits, is looking very attractive right now. And this is why Mercado Libre is the first of my, well, companies to maybe have a closer look at for a buy in December. Next up on my list is Toast. And similarly, we are experiencing, well, let's go year to date. We are experiencing a 32% drawdown from recent highs. Now, looking at the price chart, we can see, let me go, yeah. We were pretty much trading around, say, $20 to $25 for a couple of years here, 1.5 years or so. And then there was a spike up late last year. And then we've traded around up here, and now we've come down to $33 again. And now the question, of course, is whether we go back to this level or whether we go back to this level right here. I would very much expect the second to be the case. And that is because the business behind the numbers has improved quite dramatically over this time. We can see here similar numbers to Mercado Libre actually. We see that revenue has grown over 33% over the last 3 years, 49% over the last 5 years even. We see that forward, it's still expected to grow above 20% per year, a little bit slower than Mercado Libre, but still nothing to scoff at. And if we look at the total revenues year over year, this is a beautiful chart again. We see very nice consistency. And even considering that Toast, of course, operates in the restaurant business, they offer payment solutions and also physical solutions for restaurants to operate. We can see that even during COVID, where many restaurants were closed, they still managed to increase revenues year over year because the restaurants have to pay them no matter what. If the restaurants have to close, well, that's the restaurant's problem. So this is a lot stronger business model than owning a restaurant. And also, of course, you are diversified across lots of different restaurants, so you're not dependent on a singular restaurant chain performing well. You just have to, well, hope that the whole restaurant market is growing and or Toast is taking market share, which it certainly does. Looking at the earnings per share, we can see that, well, in 2024 they were break even, and now they have continued to grow. They're of course expanding the margins because they are still very slim. This is typical for a company that has been unprofitable up until recently and now has just turned profitable. Typically they can expand their margins quite aggressively in the first couple of years of becoming profitable. And we can see this even better on a quarterly view, that basically each quarter is a step up over the prior one. And I believe strongly that they can continue this. I also like to look at the free cash flow together with the stock-based compensation to also paint a picture of its profitability. And we can see here that free cash flow ever since 2022 has been steadily increasing dramatically, whereas stock-based compensation has come down ever since 2023. So we are getting less dilution and more free cash flow. That's typically a pretty good recipe for success. Also, in the most recent quarterly report for the third quarter ended in September 30, ARR grew 30%, which is nice. We have 7,500 new locations in the third quarter alone. So in the most recent earnings season, there were lots of companies in the restaurant business that reported mixed or slightly bad results, and they all warned consumer sentiment isn't too good. The consumers are getting squeezed. They don't have money to go out. They are ordering smaller items or cheaper items and all that stuff. Well, Toast doesn't really notice any of it. Of course, if the whole restaurant market declines for a long period of time, then and restaurants go out of business, Toast is going to notice this as well. But for a short term, if there's only temporary troubles, then Toast is going to be absolutely fine and, yeah, as you can see, even accelerate, take market share, and become even better. Now the question is, what do we pay for this kind of business? And if I'm just going to look at, well, we can't really take this into consideration. So if we just look over the period where they were actually profitable in terms of forward PE, so they weren't profitable back here in 2024, but their forward PE was already positive because they expected positive revenue, positive because they expected profits already. We can see that we're pretty much at the very lowest level we have ever been, 29 forward PE. Now keep in mind that the forward PE of the S&P 500 is somewhere in the 25 region, give or take a couple. And I don't think that the S&P 500 on average is expected to grow earnings at 52% over the next 2 years. So this is looking like a very attractive buy right now. We have a very reasonable valuation for lots of growth, a very strong, sustainable, and also consistent business model. And I'm very much considering buying more. I started buying on the way down here. I might have bought in too early, but you never know how low it goes. So it's not really like you can predict these things. So I might average down. Currently my cost base sits like 10-15% above current prices. I'm fine with those prices. I like the business then, and I like it even more now. So I'm considering buying more. Now, next up on my list is Kaspi. And yes, this one is currently not paying a dividend. But over the past, they have paid a very substantial dividend actually. I believe they were closing in on 8% dividend yield before they cut it. Now, why did they cut a dividend? Because typically this is something we don't like to see, especially if it's not only cut, but cut to zero. This typically isn't a good sign. In this case, though, I would say it's justified because here they have purchased a majority stake in Hepsiburada, which is a business in Turkey that is, from the idea, very similar to Kaspi. Kaspi, again, is an e-commerce business similar somewhat to Mercado Libre, which in turn is similar to Amazon. But Kaspi is a lot more localized on Kazakhstan and Kazakhstan only. And they are also a lot more of a super app where they offer many more services. So the business is a lot more complex. It has a lot more facets than something like Mercado Libre or even Amazon. And now they want to replicate their business model in a new market because they have mostly saturated Kazakhstan, and Kazakhstan isn't necessarily the most stable country, which is also, of course, a point for concern with investing in Kaspi. You should keep that in mind. But I think overall the business looks so good that I can look past that risk and still invest into the company. And now the reason I'm showing you this dividend chart is because they announced that coming next year, which isn't too far off, they will reinstate the dividend. They announced that they will buy back shares, which the share repurchase program isn't too large. I believe it amounts to just below 1% of the market cap, so nothing too crazy. But they reinstate the dividend as well. And I would expect it to be significantly lower than when it was in here, February 2025. But even if it's like half where it was there, it's still like a 5% yield or something like that. Even without a dividend, this company, I believe, is a great opportunity. And with the dividend, it gets even better. Similar to the previous two companies, we can see crazy amounts of revenue growth, 47% over the past 3 years, 43% over the past 5 years. This is absolutely incredible. This means it accelerated over the past 3 years. Typically, what we see is that as a company matures and grows larger, its revenue growth declines, which is just natural because you have a larger comparison. So it's easier to grow from, say, $1 billion in revenue to $1.2 billion in revenue, which is a 20% increase, than growing from $100 billion to 120, which is also 20% increase. I think you get what I mean. So that we see an acceleration here is very promising. And for this company, I like to look at operating revenues because they also have lots of other revenues, but they don't really represent what the underlying business is doing, which is more important for my part. But we can see this is growing absolutely incredibly. And if you were interested in total revenues, it looks similar. The numbers are just different, but the overall trend is pretty much identical. We can also see that the growth of earnings per share, it has come down over the past couple of years, which is to be expected again as the company grows larger. And of course, here late 2024 and 2025, we had the Hepsiburada investment. Hepsiburada, I believe, currently isn't profitable, so they are losing cash and they are also pumping more cash into Hepsiburada to make it profitable, to replicate their business model that they had in Kazakhstan, or still have in Kazakhstan. And so it's only natural that profitability margins are going to be suppressed. The fact that they still, despite all of this, managed to grow at 13.5% year over year is a great testament to the strength of their business model, in my opinion. And so if you consider all of this, so you have a business that is absolutely dominant in Kazakhstan, completely owns the place, basically, has incredible revenue growth, is profitable, and very much so, actually. Let me just give you the numbers. We can see that we have a net margin of 30%. Free cash flow isn't really applicable because they have a financial side of the business, banking and stuff like that. So free cash flow isn't really that useful of a marker here. But net profit margin of 30%, gross margin of 74%. And keep in mind that this is, for a large part, an e-commerce business. If you compare this to, say, Amazon's margins, it's a completely different world. So that's absolutely great. And so we have a company growing incredibly well, very profitable, very high margins. And what do you think would be an appropriate valuation for this business? Well, if you guessed anything above a PE of 6.5, and this is a trailing 12-month PE, not even forward-looking. This is for the past 12 months profit. If you said anything above a 6.5 PE, then today is a good day to buy this business, actually. And it has never really traded that high, apart from a short period of time right here during the COVID era. But ever since July of 2022, it has mostly traded in the high single-digit to low double-digit region. Also, of course, because in Kazakhstan, the government isn't the most stable. They are very dependent on oil revenue as a whole country. And so there's a lot of uncertainty surrounding it. But I mean, if I look at this right here, that doesn't look too uncertain. It looks like despite all of it, they managed to grow very well, very profitably. And they are now also diversifying into Turkey. So I'm seeing a good business, great business even, trading at a ridiculously low valuation. They are beginning stock buybacks. I wish they did more because they are so cheap. It's absolutely incredible. And they are also now restarting their dividend. So even if we are being pessimistic, right? And we said that, well, they stay at around the current valuation, which is absurd in my opinion, but sure, why not? Let's stay pessimistic, okay? They stay at a 6.5 PE. Even despite current headwinds that they are facing in Kazakhstan, and even though it's a difficult situation, and even though they are investing lots in Hepsiburada, and Hepsiburada is also depressing their profits, they still manage to grow above 10%. Plus, you are also getting, say, 1% share buyback yield, plus a dividend. Even if it's only 2-3%, you're already at, what, 12, 13, 14% return each year? And I mean, how much lower can this possibly go? I'm seeing very little downside over the long term, unless, of course, the whole situation with Kazakhstan gets terrible and, I don't know, something akin to Russia invading Ukraine or something like that happens. I don't know. Of course, there's always this risk, right? It's similar to TSMC, great company, but it's on Taiwan, and China-Taiwan is a bit of a tricky situation. So the PE is a lot lower than it would be if, say, TSMC were headquartered in the US. Similar situation here. If Caspi were headquartered in the US with the same numbers, everything the same, this would easily trade at a 40, 50 PE. Easily. And I'm not expecting this to go anywhere close to these valuations anytime soon. But I'm saying that we are already at very, very depressed profit, that we're already a very, very depressed multiple. And I would expect that, of course, it could go lower. It can always go lower. But over the long term, I don't think that there's much downside potential when it comes to this. Of course, I could be wrong here, but I like my chances. And now the last stock on our list is PayPal, which so far I don't own. I own the previous 3 companies, but I don't own PayPal yet. But I very much considering to change that and buy a first little stake in December. Now, of course, this chart right here is absolutely brutal. We are down 83.7% from all-time highs. But in this period of time here, again during COVID, the stock was incredibly, absurdly overvalued. So it doesn't really make that much sense to look at this period of time. And we can see that afterwards, well, nothing really has changed. It has traded sideways for several years now. But it doesn't mean that that has to continue. And in fact, in these cases, it makes sense to look at a business behind the stock price. And we can see, for example, that total revenues have grown not as aggressively, of course, as the previous 3 companies, but still respectably. And it is growing and growing and growing. It hasn't declined. And right here was the period of time where the stock reached like $300 or something like that, 5 times what the current price is. And if we look at the numbers, there's no real reason why it should have traded that much higher back then than it does right now. I'm not saying we should go back to $300, but it shouldn't have been at 300 right now. So my point here is that looking at the stock chart and saying, well, it's down 80%, doesn't really make that much sense because it should never have been that high to begin with. But on the other hand, I would argue that now it's depressed too much. It should be higher right now than it is. And the reason is that it is valued ridiculously cheaply. We are, if we zoom in a little bit, at a price to free cash flow of around 10, which even in this, if we ignore this whole part, it's ridiculously cheap. We are at levels that, well, we have been here in July of 2024 and then briefly here during the whole tariff situation. But other than that, we have never been this low before. And the 10 price to free cash flow means that theoretically, if the company wanted to, they could buy back 10% of shares outstanding each year, for example, which in theory, even if the business doesn't grow at all, should give you a 10% return per year, because each year you own 10% more roughly of the company. And we can see that, well, it does grow. So you should get the 10% plus whatever they manage to get growing. And this is pretty much what the company is doing. In the last year, in 2024, they bought back 7.4% of all shares outstanding. And right now, they are expected to make $6 to $7 billion of free cash flow this year. Already announced that they are buying back $6 billion worth of shares. And if we look at market cap, we are sitting at 56 billion. So this is more than 10% of all shares outstanding that are going to be, well, taken from the stock market. And we are still expecting growth here. Keep that in mind. We are still expected that revenue grows 5%. Let's say 5 or 6% plus 10% buyback yield. That's 15% right there. And also, and that's the reason why I put this into my dividend portfolio section, they recently announced that they were going to start paying a dividend at a little below 1%. And I actually like it that it's very small as well. That gives them room to grow. And I'm very much looking forward to adding this to my portfolio. Okay, this was quite a lot longer than I expected it to be. If you're still watching, then thank you guys so much for sticking around for so long. Please let me know in the comments down below what you think about these 4 companies, and if there's any companies that I missed that should have been on this list that are also great opportunities to buy. And yeah, thank you guys so much for watching, and I'll see you in the next one.